The Federal Open Market Committee at the Federal Reserve saying much less in recent meeting notes that were released. Everyday Economics co-host Orphe Divounguy joins us to talk about how he says, importantly, it's no longer saying the same kinds of things that it did previously. He joins us now. Orphe, thanks for taking time with us here on The States. So what was released Wednesday afternoon, and why is it significant?
Yeah, the minutes of the last Fed meeting basically tells you what the conversation is like in the room, what the concerns are, and gives us a glimpse at the process, right? So what do we get out of the Fed meeting? We get under the new chair that the Fed is holding rates steady, but it quietly stopped telling markets how it will react to the incoming data. That forward guidance is gone, and right now the market reaction has been longer yields, right? Treasury yields have been on the rise, and they've basically been repriced higher. So I think that is it. The market doesn't quite know what to do and how to handle, because it just doesn't know how the Fed will respond to inflation, to unemployment, to labor market data coming in. So there's a bit of uncertainty there.
Now, you note pretty, prominent in your analysis of the meeting minutes that the amount of words used seems to have been cut in half from previous minutes that were released under the prior chairman. What does that signify?
Yeah, not a whole lot. It basically tells you that the under the new chair, the Fed is telling markets a whole lot less and letting markets try to figure it out for themselves. And so that's all it says. When you look at the language, right, it changes along with the latest economic conditions. Under Powell, you had a lot of language surrounding liquidity, risks, jobs, right? So it sounded a bit more dovish, but it really reflected the fact that the labor market was kind of frozen for most of 2025. Under the new chair, you have words like AI-related investments or AI build-out and spending, right? And all of those words sound a little bit more hawkish, perhaps, but really reflect the issue du jour, right? So right now, it's the conversation surrounding fiscal deficits, surrounding AI spending and borrowing, right? And AI build-out. And so that's what the language really reflects. And what was taken out for sure is any language related to how the Fed will react to the incoming economic data.
And like you said, with a lot of the kind of forward guidance missing from these meeting minutes, that's a little bit of uncertainty for the markets to have to handle and, the economic drivers to be able to fully assess. But just some of the statistics you have here, it's pretty fascinating. The first two Warsh-chaired statements averaged 113.5 words, and that was 55% shorter than Powell's final 8 meeting minutes that were released. But you also say forward guidance taking a hit, all 24 of 24 recurring Powell-era reaction functions, those weren't in Warsh's statements at all.
Phrases, right? So things like the Fed will be prepared to adjust or assess the appropriate stance of monetary policy, right? All of those words, carefully crafted words by a lawyer really by trade, right? Former Fed Chair Powell, are gone from the statement under the new Fed chair. And ultimately, he did tell us that. He warned us that would be happening. And so we're going to kind of continue to track, what that does and how the markets really respond to that. I mean, the only thing we've seen so far is really the uptick in yields, right? We haven't seen a lot more volatility. In fact, volatility has actually gone down. If you take out the CPI days and, the big economic reports, the jobs day, right? Volatility as actually bond market volatility has actually gone down under Warsh. However, you're seeing the pricing go up. You're seeing the yields go up. 2-year yields, but also 10-year and 30-year yields are on the way up. And it matters. Why does that matter? It matters because long-term rates set your mortgage, and those rates are going up, right? With less Fed guidance, you should expect a little bit of that repricing, as the markets are not quite sure how the Fed will react to the incoming data, how the Fed will react to the fact that inflation remains well above target and that the labor market is basically frozen.
Orphe, I want you just to react, if you can, to this clip of President Donald Trump yesterday saying over and over again that if the economy is good, then the Fed needs to lower interest rates. Here's that clip.
I mean, every time I hear our country's doing well, I say, oh, it's too bad, because they lift up interest rates. They should drop interest rates because it means we have a strong country. I almost like to hear bad numbers. I'm saying, I hope we have bad numbers today. Interest rates will go down. It doesn't make sense. When our business is good, we should lower interest rates. And then you want to build America, you're going to see a building like you've never seen. We're doing great, even despite the fact of what's happening with interest rates.
Orphe, your thoughts?
Yeah, unfortunately, I can't agree. The economy is, you have inflation above target. And so the Fed just can't lower rates just now, right? If it did, it would risk unsettling inflation expectations. If inflation expectations were to start moving higher, you could see kind of wage growth also start to pick up, especially in a time where you don't have a lot of labor supply. And so the labor market remains somewhat tight because there aren't many workers out there in the labor force actively looking for work. And so the decrease in labor supply that we've seen in recent months, partly because of the slowing population growth, the immigration, the decline in net migration into the United States, well, that could create some pressure in the labor market. And so we're not there yet to start talking about cutting interest rates. And I don't think anybody on the committee would agree. In fact, from the minutes, we know that 3 people, voting members of the committee, wanted to raise interest rates, and that even non-voters, a couple of non-voters, also discussed their reasons for why rates should be higher, not lower.
Now, Orphe, all of this, obviously, the markets are watching closely, and as you've noted, it definitely signals a significant shift from the previous Fed chair to the new Fed chair here. But boil this down here. Finally, why is this important to the consumer back home that's just trying to get by week to week?
Yeah, let me just add that cutting interest rates into an environment where inflation remains elevated could actually prove to be counterproductive. It could actually cause long-term yields to increase. If investors don't believe that we're serious about keeping inflation under control, right, you'll see those yields rise. And ultimately, those yields matter tremendously for things like mortgage rates or borrowing or business borrowing costs, right? If yields continue to increase, they will actually squeeze households, squeeze businesses, and actually hurt the U.S. economy. So no, I don't agree with the statement. And maybe he said it in a joking way, where I'm not sure that the president put out. But ultimately, looking out for the American people means getting inflation under control, and that's how we're going to get interest rates to hopefully move a little bit lower.
Well, Orphe, greatly appreciate your expertise and your analysis as always, and we'll definitely check back in with you soon. Orphe Divounguy, PhD economist here with the States. We'll be right back with more.